Welcome back, dividend and value investors. If you are new to this channel, welcome. I am European dividend growth investor. In today's video, I'm going to dig a bit deeper into one of my discoveries from this year. It's a relatively new dividend stock in my portfolio that is fully delivering on its commitments. I only just initiated a position in January this year to start following the stock and further build my opinion. Well, what can I say? I'm only more bullish after today's earnings report. Having said that, in this video, I'll walk you through some of the highlights of the earnings report, and by the end of this video, you should have a clear picture on why I'm bullish on the stock and why I aim to invest more into this. Guys, in today's video, you guessed it, I'm going to talk about Viatris, so let's get started. So what you can see here is that Viatris is only so far, let's say my 32nd position or something like that in my portfolio. It is currently trading at around $11 after today's 15% price hike due to the earnings announcement. It's currently about 1.3% from my portfolio allocation and 1.6% in my dividend income allocation. By the way, if you liked such a Google tracker as this one to track your dividend portfolio, then please see the link in the description of this video. But hey, let's go to the meat of this video. So Viatris reported definitely strong third quarter 2022 results. This time I should give management a tap on the shoulder and tap on the back that they are actually not fooling us here. So they had US GAAP net earnings of 354 million, but free cash flow, this is the important number here, of 765 million. Why is this the important number? Because this company is relatively new after the spin-off from Pfizer and the merger. So, they have a lot of write-offs related to that merger, related to the costs, related to everything they take with them as luggage into this new company. Hence, free cash flow is really what counts here. And so far, until this time in the year, they have already 2.5 billion in free cash flow. What I would like you to realize here is that the company currently has a market cap of 13.3 billion. We're talking about a price to free cash flow here of in between 5 to 6. This is really cheap when looking at wider market conditions. So this is also one of the reasons why I'm really thinking it's undervalued. But the question, of course, is like, hey, maybe this company is rightly so at a 5-6 PE trading here. Well, this is something that I really would like to challenge. I think this is really such an under the radar dividend stock. It is ugly because for many people, they don't like to see declining revenues, but this is really expected from this company, and management is really transitioning into another kind of business. What is this business? Well, they gave an update on that in February, and they are moving more and more into life sciences, and with that also selling more and more of their over-the-counter businesses. So what that means is that today they also gave a strategic update because they entered agreements to acquire Oyster Point Pharma and Family Life Sciences for an aggregate 700 to 750 million in cash. You need to know that they are now, with this, entering really strongly into the ophthalmology business. But let's go back first still to the earnings announcements, because they have again so far paid 2.1 billion down their debt. They had to do this because their company was heavily loaded with debt when they entered into this new company, when they started 2 years ago after the spin-off. Because let's remind ourselves about this. Before they return to growth, because this is their phase 1 commitments that they are talking about, they wanted to pay down at least 6.5 billion of debt because they are really committed to continue having an investment grade balance sheet. This is really important for the company. They want to really be seen as a reliable and mature company. So from that point of view, they're really doing what they are promising. Okay, let's go back to the earnings then. So if we look at these earnings, was there anything that caught my attention in this earnings report? Nothing more really than their enormous free cash flow that they are already generating right now. So this is really nice. And beyond that, I looked a little bit at the income statement. What is important here to see is that, for instance, they have now 1.2 billion of shares outstanding. So on a 2.5 billion free cash flow, we're talking about a free cash flow of $2 per share at a current share price of 11. Again, this shows you how lowly valued their earnings multiple, or let's say differently, their free cash flow multiple is. Other than that, there's really nothing here to be concerned about. Their debt is being paid down. You can see it continuously reducing here. Also in the other current liabilities, again, 2.5 billion off here. On the other end, they have been doing, of course, sales and write-downs. So what you see as well is a decline in intangible assets and goodwill, all predicted. It's all according to their plan. And this is important when we have such a business that is really just shaping as a company, was loaded with debt by their parent company in the past, Pfizer, and the merger that they had. You need to really look at this. So they are doing this, and with this, in 1 year from now, they think they will be able to enter phase 2 and go back to growth. And this is also where the strategic update was really important, because, for instance, if we look at this acquisition here, right, of Oyster Point and Family Life Sciences, they are already thinking that it will be at least generating 500 million in adjusted EBITDA by 2028 on a cost price of 700 to 750 million. So in 5 years from now, for me, this would be a really good deal if they are really able to generate this. What is good to know, they got from a really smart analyst in their investors earnings call, they got a question here whether this wasn't a bit too optimistic, because outside analysts were not giving such a high adjusted EBITDA forecast for this company. So the CEO responded here like, 300 million or something like this is coming from their core product that they are currently having on the market. And then they also see some pipeline strengths, but they said a certain amount comes from the US, but you also need to look at the opportunities in Europe. This company is really diversified, gets a lot of earnings from outside of the rest of the world, from the US. So, I think there is something to this, but this is also a risk. It might be that the management is too opportunistic here and that they won't be able to realize these predictions. So you need to really model that yourself, whether you think this is fair or not. So far, from what I've seen from management in the last 2 years, I would like to give them the benefit of the doubt. Now, when we look at the financial targets for 2024 to 2028, I love this. Top line total revenues CAGR of 3%. Adjusted EBITDA CAGR of 4 to 5%, but this is my metric that I really want to look at here. Adjusted EPS CAGR of mid-teens. I mean, if they are able to spot this, we're really talking about a business that will be on fire, and the share price where it is today, I can't imagine it to stay there. Again, they are committed to maintaining its investment grade rating, and they continue to be focused on deleveraging their balance sheet. Now, what's more that caught my attention, how the net sales was impacted by the currency exchange rate, because they are domiciled in the US as a company and they get a lot of earnings from abroad. So you can see already almost 8%, 9% is simply an impact in the sales from currency. Other than that, sales was almost flat, which is quite an achievement on itself, because they were actually guiding less for what they will be making right now. So I found this a really, really interesting slide. Now, what's more, there was another slide here that I really wanted to show you. So I mentioned already about the debt repayment, but look at this. 1 billion share repurchase authorization. And guess what? They announced today that from 2023 onwards, they will start buying back 1 billion of their shares. That's approximately, at the moment, 8% to 9% of their shares outstanding. I mean, this just on top of the 4.5% dividend that we get approximately right now would mean a return of capital of 12.5% if they would finish this entire share repurchase program in one single year. Now, I'll take this really, really at any time. But hey guys, what I also really wanted to show you quickly is some of the highlights of the earnings call, because it was so interesting. And I would definitely also recommend you yourself tomorrow, put it on as a podcast. You can go to the Quarter app and you can really listen it yourself. There's also the script here. So, but I mean, this call was really strong. There was a part of it, I think after 5 to 10 minutes, where I fell asleep for 5 to 10 minutes, but then when the questions came again, it went really well. Now, what is important here, what I wanted to show you is when we go to the questions, and I believe it is here somewhere. There you go. Gregory Fraser, I love this one. It must really be a long-term dividend investor. How should investors think about the mix between funding the dividend and share buybacks in 2024 and beyond, given the 50% targeted for free cash flow allocation? I guess a material increase in the payout ratio is likely. Well, Robert Curry here, he started to, mumble a little bit. What he said here is, I think the most important commitment today is commitment to the 50%. Okay, fine, great. But we want to hear about the dividends, my friend. What he says here, and here comes the story, he really likes where the current PE multiple is. Like 5 to 6, right? A multiple here. If we take the least from the free cash flow. What he says here, if it were today, I would probably strike much more on reinvesting in our own business through the purchase of our own shares. I think that what Viatris is going to become is very quickly an extraordinary strong adjusted earnings per share growth story once we begin to execute. And especially the repurchase of our shares is going to go a long way, I think, in that story. So here you have it. So what my expectation therefore is around the dividend. It was 11 cents per share on a quarterly basis last year, 12 cents this year, maybe 13 cents next year. They could easily add another 4 or 5 cents with these cash flow numbers. But I think this is what we will see. Probably 13 cents per share per quarter and then massive buybacks. Now, but where are they going to get these buybacks from? And here also Nathan Rich gives also a question here. I guess, how should we be thinking about the baseline for free cash flow? Because this company is, selling some of the legacy businesses, acquiring new businesses. It's really a portfolio transition. We'll see more of this in 2023. I think it will be hard a little bit sometimes to even digest the numbers, but I think we get the answer here. I think we gave you the starting point of at least 2.3 billion in what we see in as a starting point. But we absolutely see it growing from there. So, I gave you now some of the highlights of the earnings report of the acquisition that happened. You can dive further into it, go to the quarter apps, listen to it. You get so much more wiser. But what I want to do now is go back to what I modeled at the start of this year. So at the start of this year, I took a free cash flow of 2.4 billion with the shares outstanding that we have today. And then I took a 4% growth rate and a 2% growth rate thereafter. So what the company is saying now, the bottom, because also if you read further, it's saying the baseline 2.3 billion could also be 2.7 billion. So let's model this back to 2.3 billion now that I've got even better visibility on this. And also, let's say the growth rate, we continue to be a little bit really prudent here. But then thereafter, it could be more, because this is really what the company is thinking, right? So if we give the discount rate, let's say 10%, it's maybe, let's say 12.5% even in the currently high inflation environment. And let's assume that they will be able to double the current multiple from 5 to 6 till 10. In that case, right? In that case, and this is what I call the baseline case, we're talking about an entire fair value of 25 billion, which is twice the market cap of today, almost, of 13 billion, and therefore a fair value per share of $21. I really think that this is realistic. I really think this. So what are the risks involved here? Really is that they are not able to transition into this future strategic goal that they have, and that they will get really material free cash flow impact. Another risk here could be is that, for instance, one of their products seems to have a failure and therefore large litigation coming up. We've seen that with Philips. We've seen that with other healthcare companies. This continues to be a risk over the company. But look, this is the baseline case. We can go more bearish. We can also go, let's say, on a decline here, minus 4%. And let's say it's still in the upcoming years just flat. They are not able to do it. We'll also give it here 12.5%. A multiple, therefore, of 6. It will not be able to leave. If this is the case, and we're talking about the bearish case, in my opinion, it would be still worth $13 trading today. So, guys, I really think that this company is heavily overvalued. But let's say also an optimistic case. Let's say the free cash flow will grow 5% in the next 4 years. And then it will grow, let's say, in the teens. Let's be really optimistic here. At a multiple of 12.5, a discount rate of 12.5, but I also think it warrants a higher multiple. Actually, these are numbers for a 15 multiple. If this is the case, guys, we're really talking about an extraordinary number, and then we're talking about tripling the current share price, going to a $32. Now, all in all, with an increased discount rate compared to how I was modeling in let's say, several months ago, let's say in the beginning of the year, when it was around fair value of $25, taking the numbers into today, I still think it's worth $21 right now. So guys, I'm going to buy more this week at around $11 trading now, so I expect some added shares tomorrow into my portfolio. I'm really bullish on this one. I think the risk reward is really favorable to me. I mean, if we talk about the margin of safety, this is, in my example, a company with a strong margin of safety. Of course, this is not investing advice, guys. I'm sharing you my thoughts. I'm sharing you what I'm doing. I explained you the few risks that are really with this company, and that's all around management execution and potential product defaults. So take those into consideration. Just don't buy what I'm buying just like that. Please do yourself a favor. Go to the Quarter app. Read the quarterly report, listen to the earnings call, and build your own opinion. Guys, this was it from my side. I hope you enjoyed it. Don't forget to like and subscribe this video, and see you next time.